All right, good morning, everyone. Thank you for joining us for class number 5 for our virtual education. We have with us Carmen Faison. Carmen is a partner with Mitchell Wiggins and specializes in closely held and family businesses. She is a regular speaker for the firm on topics including COVID relief programs and tax updates. Carmen was previously named a top 5 under 35 CPA by the Virginia Society of CPAs and a super CPA by Virginia Business Magazine. Welcome.
Thank you so much. I'm going to drop my contact information into the chat for anyone that needs it. You're welcome to ask questions in the chat or unmute and ask questions as we go through the presentation today. Thank you so much for having me again today. I really enjoyed presenting to you all last week on worker misclassification, independent contractors and versus employees. But we have a much different topic this week. But before I get into that, I'm going to share a little bit more about myself and about the firm for those of you. I know there are a few folks that were not on last week's presentation. So I am a partner with Mitchell Wiggins. I've been with the firm over 16 years now, and I do focus mainly on family-owned businesses. I grew up in a family business. My parents started a manufacturing business that my husband and I still own, and my husband runs today. So I am very familiar with small businesses and the challenges that arise in those businesses. I am also a member of our PPP task force, our COVID response task force, and I've authored many of our blog posts and our email blasts. And I think I failed to mention this last week. We do have a really great newsletter series where we try not to spam anybody, and it's for more than just clients. So if you're interested in getting updates from us, it's really just pertinent business taxation updates. You're welcome to send a chat in with your contact information, and I will gladly add you to our email blast list. We try to be really timely with current events. Again, I've been with the firm 16 years. I'm a graduate of Longwood University, and I'm currently working on my master's in taxation from Villanova University. Mitchell Wiggins, for those of you that aren't familiar with our firm, we're a traditional public accounting firm. We provide audited financial statements and taxation services to individuals, businesses, partnerships, nonprofits. But beyond that, we do offer some unique services that I think cater really well to family businesses. We also have an estate and trust department that we can work with legal counsel to provide estate planning, estate administration, and trust administration. And we also have a business valuation department. And our business valuation department works very closely with our estate department and works really closely with our business taxation department. So we can provide some great assistance for mergers and acquisitions for folks that are ready to exit. We can connect you with business brokers, help you value your business, determine what your sales price should be. So we think we have a suite of offerings that are unique in our marketplace and really provide a great support system for the tax and compliance side for small and family-owned businesses. We have many family-owned businesses that are clients of our firm, and one of my favorite things about working with Mitchell Wiggins is we have been able to see these businesses be successful through multiple generations. So currently we're working with businesses that are on the 3rd and 4th generation of family ownership. And if you know anything about family businesses, that's extremely rare. It's very rare for them to make it to the 2nd generation, and the odds just get continually lower onto the 3rd and the 4th. So we like to think that we are a very small part of the success in transferring those between the generations. We have offices in the west end of Richmond and in Petersburg, south of Richmond, which is where I'm talking to you all from today. We've been in operations for over 75 years. And a lot of our clients are probably just like you guys. We do a lot of manufacturing, construction, as well as a really large nonprofit practice. We have several partners that almost exclusively focus on nonprofits. So Mitchell Wiggins, at the very beginning of the pandemic, knowing our background and our client base, we knew we had a lot of clients that would be very interested and frankly need these PPP programs. So we decided to create what we call, it started out as a PPP task force and quickly evolved into a COVID response task force. So we identified 8 individuals within our firm, varying levels from brand new staff all the way up to several partners, to become the experts in these programs. And that has really helped us serve our clients and some folks that aren't our clients really, really efficiently. We've been able to provide real-time information on updates on these programs. If there are any of you that received these PPP funds, it was very hectic at first, continued to be hectic as they changed the program, they changed the rules for forgiveness. So we're going to go through some of those rules today and a brief overview. And then also, it wasn't on the original agenda, but after having discussions about another program that's become very hotly discussed lately, we added some information about the employee retention credit. So this is a really great tax credit that is also related to payroll. Excuse me. So we're going to dive into that one just a little bit. So I will put the caveat out there that we also do a full hour webinar on employee retention credit. So covering PPP forgiveness and employee retention credit, in 50-ish minutes. I'm not going to be able to cover the entire program. This is a brief overview. If you think you may qualify based on the information we provide today, please contact your advisor. Please contact your advisor. Excuse me 1 second. I'm sorry. I'm sorry for the interruption. So if you think you qualify for this credit, please contact your advisor and let them go through your unique situation. There's a lot of nuances to this credit. There are a lot of differing qualifications that we're not going to go through today. We are doing consultations with people. So what we've been running into is a lot of businesses are finding that their tax advisors are not diving into these credits and they are not getting up to speed, and they're basically saying we're not going to do this work for our clients. And so we have had some businesses come to us that we are not just typical tax clients for us, and we've been doing the consulting work for this, and I'll provide some information about that at the end. But caveat, this is not complete information. Please contact your advisors regarding your qualifications for this. Okay, so I wanted to dive into a little bit of PPP history before we get started here into the details of forgiveness. So for those of you that maybe aren't quite as familiar, just to give a brief historical aspect, the PPP program was born in the CARES Act in March of 2020. And so that was really the first COVID relief bill that we had. The funds went very, very quickly, if many of you remember, but they did, add more funds to the program. So there were many, many businesses that were able to get PPP loans in 2020. There were some nonprofits that were ineligible, so 501c6s were not eligible. And then in 2021, when the program was revamped, some of those businesses were able to get funds. So that was the program was resurrected in the Economic Aid Act in December of 2020. So we sort of refer to these as PPP round 1, PPP 1, and PPP 2. So there are businesses that have received 2 PPP loans. Some businesses only received 1 because they didn't qualify for the second round. But the program was intended to provide employers funding to keep employees on payroll. That was the goal. And in my opinion, I do think the program worked. I think, especially in March of 2020, April of 2020, I think there was a lot of fear and a lot of uncertainty. And I think the goal of the government was to basically have small businesses work as, agents of unemployment commission. So rather than filtering the employees through the unemployment commission, saying we're going to give you the funds and you're going to keep paying them instead. So the loans were guaranteed by the SBA. So although you were applying through a lender, the SBA was 100% guaranteeing these loans. There's very little risk for the bank. And they are forgivable for certain uses, which I think pretty much everyone knows at this point. But the real beauty of these loans, beyond the forgivable amounts, is there was no collateral or owner guarantees. So even if you didn't think that your business was going to survive and you didn't think you were going to be able to pay the funds for forgiveness, you weren't required to do a personal guarantee or put up any collateral. And so that was really huge initially in the program. So some PPP-1 statistics. So these are just 2020 loans issued from the CARES Act. The national average loan amount was $101,000. So, really small, really getting to these small businesses. 5,460 lenders were providing these loans. There were 525 billion loans issued in 2020. And 12 billion of those were, 12.5 billion were issued in Virginia. And there were over 5 million borrowers. So you hear in the news about a lot of large businesses getting these loans, but there were many, 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 many small businesses getting them. And I'm going to update on some forgiveness statistics because really what we're talking about today is forgiveness. The applications are no longer available to apply for these loans. Of course, with things changing every day, Delta variant, there's always a chance that they, add some more funds to this program and PPP3 becomes available. But currently right now with what we have in legislation, you are not able to apply for PPP loans at this time. So we're really focusing today on forgiveness. So July 28th, as of July 28th, there were about 400 billion loans that had been forgiven, but still roughly 400 billion loans outstanding. So that includes PPP-1 and PPP-2 loans, so all of the PPP loans outstanding. But of those loans outstanding, 93% are less than $150,000. And from our experience at Mitchell-Wiggins, what we have seen is that those are the people who are the most uncertain about how to do this process, how to go through the forgiveness process. And it can be very overwhelming. You're signing under penalty of perjury to a federal agency when you're completing these forms. So hopefully we can go through some details today and it will remove some of that apprehension about going ahead, filing for forgiveness, and getting these loans forgiven for your businesses. We're going to move in now into the forgiveness applications and look at that process. So I wanted to start out with a PPP forgiveness timeline because I think it's really important to understand, the pieces of the forgiveness timeline. So let's say on April 28th, a borrower receives a PPP fund and they elect a 24-week covered period, which we'll talk about in a few minutes what a covered period is. So that 24-week covered period ends on October 13th of 2020. And then that borrower gets their information together really, really quickly, and they submit their PPP loan forgiveness application to their lender on Halloween, on October 31st. Well, the lender has 60 days to provide their decision to the SBA. So the first step is after you apply for forgiveness, you're submitting that to your bank. The bank is going to review that forgiveness application. Certain forgiveness applications require that support is sent with them. So the bank will review that support. They are going to compare what you're applying for forgiveness to the application that you did initially, to the initial loan documents. What's nice is that if you're using your bank's forgiveness portal, sometimes that information's already completed for you. You don't have to dig out those documents. But the lender has that 60-day period to provide their decision to the SBA. So once they review it, they will submit it to the SBA and say, we think everything looks good. We think this loan should now be forgiven. And then the SBA is supposed to have 90 days from that point to give their final determination. I'll be very frank and say they have not held to that 90 days. For smaller loans, I would say loans under really probably under 500,000, it's been fairly quickly. But the larger your loan is, and especially if your loan is over 2 million, those decisions have taken significantly longer depending on the time period. So, if there's a lot of volume of forgiveness, what we saw was in early 2021 when applications were coming in and the SBA was also processing applications and forgiveness at the same time, they were extremely slow. So I would say if there's a reason that you are trying to get loan forgiveness and you want it done quickly, and especially if you have a larger loan, the sooner you can do your forgiveness, the better. There are a few situations where we've seen businesses that need to have the forgiveness done quickly. Most of the time, the people are in the middle of selling their business and they need the loan, the PPP loan forgiven prior to closing of the sale of the business. So in that example, you would want to get your application filed as quickly as you can. So SBA has a forgiveness decision deadline of March 31st. And then the biggest question that we have had lately is, when do I need to file for forgiveness? What's my deadline for filing for forgiveness? And what we've generally been telling people is you want to apply for forgiveness before you have to start making payments on these loans. So the loans came with a deferral period, and a lot of people weren't really aware of this, but if you don't apply for forgiveness, you do have to start making payments on these loans. And so the deferral period is 10 months after the end of the covered period. So in our example, our covered period is 24 weeks and it ends here on October 13th. And so it's 10 months from this date. So then it would make it August of 2021. So we've been very busy over the last couple of months, really working to get round one forgiveness applications in before that deferral period is over for our clients. I think we have just finally completed the last PPP round one forgiveness application last week for our clients. So we were able to get all of those done before the deferral period starts. Now, what happens if you have to start making loan payments? If you've kind of procrastinated on this, and if you have a PPP loan right now, you may already be getting notices from your bank saying, hey, you're going to have to start making payments soon, because we know the banks have been sending those out. Let's say you make 3 payments before you submit your forgiveness application. The bank will refund you those payments when the loan is finally forgiven. But the hard deadline for applying for forgiveness is the maturity of the loan. So these loans were initially, and at the very beginning of the program, had a 2-year life, so a 2-year maturity. And then at a point in the middle, they sort of changed things and extended them to 5 years. So depending on what your loan documentation is from your original PPP loan with the bank, you could continue making payments all the way right before your last payment and apply for forgiveness and get all that refunded. That's a little silly. We don't recommend people do that. So our recommendation is try to get that forgiveness in before your deferral period is up. So that's the PPP timeline. And now we're going to dive into some of the logistics of the forgiveness process. So there are 3 different forms to choose from for forgiveness. And this has been really overwhelming for a lot of our clients. I will say that for the most part, banks who have portals set up where you can apply for forgiveness online go through a pretty good questionnaire process in the beginning where it will direct you to the correct form. So for example, the form SBA 3508S, which is S is for small loans, that is only for loans under $150,000. And so it will go, it may even know from because it's the bank's portal that your loan was under 150 and may suggest to you, it looks like you can use the small form. Would you like to use the 3508S? The 3508EZ is a simplified form. It is for individuals or companies who did not reduce the salaries of their employees by greater than 25% and did not reduce their number of employees. And I've had a lot of people say, well, I had 3 people retire in the middle of this, or had, people just quit on me. And everyone knows you can't hire anyone right now. I mean, the job market is just crazy. And we're going to talk about some safe harbors to that no reduction in the number of employees. So we've had some folks think that they had to go through and fill out the 3508, which is a significant form. And after consulting with us, we've determined that they really are eligible for the 3508EZ, which is a much simpler form to complete. So those are the 3 form options. So once you've determined what your 3 forms are, or which form you qualify for rather, it is time to look at your eligible expenses. So what expenses can you use in order to receive full forgiveness? Because that's the goal, is to be able to receive full forgiveness. So the required use of funds in the original legislation in the CARES Act that was passed in March of 2020, the original requirements were payroll and employer paid employee benefits. So that employer paid employee benefits was really interpreted narrowly to health insurance and dental insurance. There were some updates to that where it expanded it to some additional benefit coverage. Rent, utilities, and interest on loans. Now, those were the original requirements, and they were updated later to also include worker PPE and safety modifications, specifically, plexiglass that's, put in office spaces, or, any sort of like wood construction to segregate employees. All of those costs could be used as forgiveness expenses. A really interesting one is expenditures to suppliers that are essential at the time of purchase to current operations. And I've had a lot of people ask me, like, what does that mean? That's a very gray description of a cost. And I think the best example that I can give is we had a situation with one of our manufacturing clients right after they got their PPP funds in round 1, where they had a significant drop in revenues, 80% drop in revenues. Revenue stopped for them. And they were not receiving payments from any of their customers, but their suppliers were still demanding payments. And so they said, we have to take these PPP funds and use it to pay our supplier, because they're not going to ship us any goods. We're not going to be able to continue our current operations unless we pay our suppliers. So it was essential. And so that's the best, definition that I have as far as, what would constitute this. If you have some sort of supplier payment where you have got to make that payment to be able to continue functioning, then that could potentially qualify. And then covered operating costs, including computing services, HR, and certain accounting services. So here, the best example I have is if you use ADP, Paychex, Dominion Payroll, any of those type of companies to process your payroll, those fees during your covered period would be eligible. If you use online QuickBooks and you have a QuickBooks subscription, those expenses would be eligible expenses now. Now, payroll costs are very important to consider what counts as a payroll cost. And like I said, the benefits have been expanded to health, dental, vision, life and disability insurance, but it has to be paid by the employer. It can't be the employee contribution. Retirement plan contributions are also eligible, any employer portion of your retirement plan. And then base compensation, again, employer paid, and non-owner. Now, I will warn you that owner compensation and owner's family is subject to lower compensation eligibility for forgiveness than employees are. And where that came from was originally with the loan forgiveness program, you had 8 weeks to spend these funds. That was the original CARES Act legislation. That was changed and expanded to 24 weeks later. But what legislators came out and said was, we don't want a very, very small business that has maybe 4 employees, husband, wife, and then 2 employees, to be able to lay off their 2 employees, continue paying the husband and wife, maybe even increase what the husband and wife get, and still be able to get full forgiveness. So they effectively wanted to close this loophole in advance, and they limited the owner and the owner's family compensation. So that is limited to $20,833. So just be careful when you're doing this. If you're doing your calculation and you have any lineal family members, parents, family businesses, siblings, anything of that nature, you want to make sure you identify all those and limit those family members. And non-payroll costs can only make up 40% of your forgiveness. Early on in the beginning, we were saying, well, it's just if you have it in all payroll, you've got 24 weeks to use it. If you've got all payroll cost, just use your payroll. Don't even worry about diving into these non-payroll costs. It's simpler just to use all payroll. Well, the game changed a little bit with that when the employee retention credit came out. And we'll talk a little bit about that when I get to the employee retention credit. So if you heard early on, like, oh, just apply with all of your payroll cost, that prior to December of 2020, that was sound advice. But now we have to take a hard look if maybe that's the best course of action with applying for forgiveness, because you're allowed up to 40% of your loan forgiveness can be non-payroll costs. And those are those rent, utilities, interest, PPE, all of those expenses that we listed earlier. Right now, we're going to talk a little bit about the covered period. So the covered period is the use of funds forgiveness period. And so those are the dates through which you are allowed to identify funds that you've spent and include those on your forgiveness application. And this has been one of the most confusing aspects of this entire program. I think the rules have changed on this half a dozen times, but currently, as the current SBA guidance has, is there's great flexibility in this covered period now. So it begins on the date the lender disperses the PPP loan. We have seen some delays in this. So we saw some instances where you may have been approved on a Thursday for your PPP funds, but you didn't actually receive them into your bank account. They didn't fund the loan until Tuesday of the next week. So that's when the clock starts ticking, is when you actually receive those funds. I've had to explain that to a couple of bankers when they want to use the loan date, but it doesn't actually start ticking until you have those funds in hand and are able to spend them. And your covered period ends on any date that occurs between the period beginning 8 weeks after the disbursement date and the period ending on the date 24 weeks after the disbursement date. So you really, fancy way of saying, anywhere between 8 and 24 weeks, you can choose your covered period there. That is really, really helpful. Again, if you qualify for the employee retention credit that we're going to talk about in a little while. I also want to note that if any of you are using accounting software, that you are able to classify expenses I know you probably all have job costing that you need to do with your accounting software, but it's really helpful to classify your PPP cost within your accounting software and to be able to run a report of the specific expenses that are related to PPP. For any of you that are using QuickBooks for the Contractors Edition, there's a class function in QuickBooks. Just because you start using it for PPP doesn't mean you have to use it for everything. You can just use it for PPP this one time and never use the function again. But you can go through and identify those payroll periods, those costs, and effectively be able to create a PPP report that way. And we found that to be really good documentation to help you kind of with tracking of PPP. So now we're going to move into the safe harbors, and I'm going to go back to the applications really quickly. So our safe harbors are going to apply to this being able to use the 3508 EZ here. So no reduction of salaries and no reduction in the number of employees. So if you have either of these, it's a very intense calculation, doing some various look back periods, and then reduction of employees. Really, it's layoffs. Did you lay off anyone? Did you cut the salaries by 50% for your employees? And if you did that, it could impact your forgiveness calculation. But the biggest question we've had is, well, what qualifies for a reduction of an employee? And we have these safe harbors, which are fantastic, and I'm so glad that they provided these. So you're looking at previous levels, and there are a couple of different options, look back periods that you can look to, and you're looking at either reducing employee count or wages. We haven't seen in our experience a lot of wage reduction past that 25%. We did see some businesses cut 10, 15%, but nothing that rose that really past that 25%. What we have seen is reduction in employees. We had some folks lay off the employees, but if you restored those employees either until the end in 2021, by the end of your covered period, if you restored them by the end of your covered period, or in 2020, if you had restored them by the end of the year, so you'd brought everybody back on by the end of the year, it was not considered a reduction in employees. So you could qualify for this EZ. Now, what we started experiencing is we had clients who, laid off many employees and then said, all right, guys, it's time to come back to work. And the employee said, no, I'm not coming back. I don't want to be exposed to COVID. I'm high risk. I live in a high risk household. So if you had a written offer to rehire an employee and then the employee subsequently rejected that offer, that is a safe harbor, and that employee does not count for FTE reduction for this calculation. And I've had a lot of questions too. Hey, doesn't that also mean they no longer get unemployment? Yes, you're absolutely right. If they have an offer for employment and that employee rejects that offer, they are not eligible for unemployment. So, you can also take that documentation to the VEC, and they can, can help to reduce your unemployment load. Fired for cause, if you have documentation that they were fired for cause, documentation that they voluntarily resigned or requested a reduction of hours, even an offer to restore a reduction in hours and the employee declined and wanted to stay part-time. We saw this with a lot of families who had children that were doing virtual school. They needed the part-time hours to be able to help their kids with virtual school. And then if you were unable to hire similarly qualified employees for unfilled positions by December 31st, 2020, and if that isn't everybody in America right now, I think this is really a very easy safe harbor for the most part to hit. And this does say by the end of December 2020, but this safe harbor would apply here in 2021 to the end of the covered period for 2021 loans. So my advice is take a look at your safe harbors. If you use Paychex or ADP, they have some, or even Dominion Payroll, they have some really great reports that you can run, and they will calculate forgiveness for you. I warn you that if you don't go in and indicate employees that don't count for the employee reduction, your reports may be incorrect. So for the clients that we've been assisting with PPP forgiveness, and we have been using their ADP and Paychex Dominion Payroll, we've been gaining access to their reports. We've had to tweak some of their reports if we determined employees met the safe harbor, employees that left. And so we were able to get them full forgiveness based on those analysis. Okay, now we're going to go into some potential issues here. And these are really, really important because the self-rental of property is something that I think has really flown under the radar with PPP forgiveness expenses. So initially, when the guidance came out, there were no restrictions for self-rental property. Now, let me define self-rental property. So that is when a business rents property from, for example, the owner of the business. So we have this frequently where the individual owner owns the building, may own it in a separate LLC. So, rental LLC, rents to operating company LLC, contracting company LLC. Well, rent is an eligible expense for PPP forgiveness, but what the SBA came out and said was, if a business owner is renting the property to their business and they don't have a mortgage on that property, then they are, unfairly getting additional funds from the PPP program. So if you have that self-rental situation, you're not allowed to use your rent expense. You have to look through the rent to the rental LLC or the individual owner. And if that building is encumbered by a mortgage and the mortgage is still owned on it, you can use that underlying mortgage interest. So they're basically collapsing the rental relationship at all. And they're treating it as if the rental relationship didn't exist and the operating company owned the building and had the mortgage itself. So, my caveat to this is if you can get to full forgiveness without providing all that extra information to the SBA, a whole extra related party, all of your loan documents, trying to explain all of that, it may be simpler to exclude rent and mortgage interest from your calculation if you have a self-rental relationship. And again, just bringing it up again, rules of attribution for owner compensation. Business owners, father and daughter are also employees. They're each making $150,000 a year. They are limited to the owner compensation limits because they are attributed owners, because they are directly related to the owner of the business. So just be very careful in your familial relationships. Another word of caution is don't double dip. So if you are putting funds on your PPP forgiveness application, expenditure of funds, make sure you are not also using those funds for other purposes. A really great example of that, again, the employee retention credit, we're going to talk about that in a minute, but also the FFCRA sick leave credit. That, if you're unaware of that credit, that was a mandatory sick leave for 2020, optional sick leave for 2021. So if you paid an employee to be out while they were quarantining, to be out while they were awaiting test results, you were not allowed to, in 2020, you were not allowed to reduce that employee's vacation or sick leave by that time. You had to use this special COVID sick leave. Now, with a mandate like that, that could be detrimental to a small business. So they provided a credit, a fully refundable credit related to that sick leave. So if you had any of those situations where you had someone out that was quarantining, had someone that was out sick, for example, we had a veterinarian practice who the entire office had to shut down because they had a breakout in the office. So the entire office shut down for 2 weeks. Everyone had to quarantine. So 2 full weeks of payroll was basically reimbursed through this COVID sick leave credit. There are some maximum amounts on it for highly compensated people. But if you had any of those credits, you cannot also use those funds for PPP forgiveness. Rebuild Virginia grant program. I don't know if anyone received those funds, but that was a grant program that with the CARES Act from March of 2020 provided certain state funding to the states to disperse however they liked. So in Virginia, we set up the Rebuild Virginia Grant Fund, and you had to apply to the program. It was a little bit confusing. It changed very rapidly, ran out of funds very rapidly. But there is talk that some of the funds that they've been getting, the state government's been getting some of the surplus funds that we have right now, may go back into Rebuild Virginia Grant Program, and they may open that back up again. As an example, this is the kind of information that we share in our email newsletters. So if you're interested in knowing when these things are happening, please send me you can send it directly to me in the chat, your contact information, and I can get you added to that. But if you are, applying for Rebuild Virginia grant using payroll cost, make sure you are identifying that you have enough cost outside of your covered period to use those grant funds. If you received any federal funds for any federal grants, this probably in for-profits, not very common. We did see it in Health and Human Services grants for some medical practices. They cannot be used for PPP funds. And then other grants as well. If you received any locality grants, a lot of the localities were doing $1,000 to $10,000 grants. What we recommend is just making sure you've got those earmarked for other expenses outside of your covered period. Again, using those classifications within your accounting system is a really great way to make sure you're identifying those. So that is a really quick overview on the PPP forgiveness program. I'm going to pause right here and just ask really quickly if anybody has any questions on PPP forgiveness. The dates on here were sort of focused to 2020, but they can be applicable to 2021 as well. Any questions? Feel free to unmute or chat in if you have any questions at all. Nope. Okay. So now we're going to talk about some tax implications related to the PPP program. And this is really important because, especially from a state taxation level, I think there was some confusion on this. And so, just might want to make sure your tax practitioner did this correctly if you received a 2020 PPP loan. So PPP loans were determined after much debate and some argument from the IRS to be fully non-taxable. And so what that means is the expenses used for forgiveness are deductible for federal income taxes, and the income received from the forgiveness of the PPP loan is considered tax exempt income. So there was some confusion about that. In mid-2020, the IRS came out with some interpretation saying that you couldn't deduct your expenses paid with PPP funds, but that was clarified, legislatively changed with Congress. So they are fully deductible. For Virginia made the decision to effectively tax PPP loans over $100,000. And based on our conversations with Virginia Department of Taxation, that should be, let's say you got $150,000 PPP loan in 2020. You should have increased your Virginia taxable income by $50,000, $150,000 loan less $100,000 that's allowable as non-taxable for 2020. We saw a lot of errors in business returns that we received from other clients related to that. So it was confusing. It was a late change. It was really frustrating for us as tax practitioners because the change we delayed a lot of filing of returns because the legislative change was decided, or legislatively decided on so late in 2021 during tax season. And then another important item, and this is a little bit complex, but if any of you are S corporations or partnerships, if that's how you are filing your tax returns, so you would file a Form 1120S or a 1065. The IRS provided that the income from PPP forgiveness will provide basis to you. So that is important for some certain loss situations. So to give an example of that, if ABC S Corporation, again, received a $150,000 PPP loan on June 8th, and they applied for forgiveness on December 1st, 2020, and SBA issues forgiveness on February 14th of 2021. And then subsequently they filed their 2020 tax return with a $100,000 loss. They may or may not be able to use that loss in 2020, depending on whether or not they had basis before that, but they should be able to use that in 2021 when they receive the basis from the PPP forgiveness of the loan. So if you have a basis situation, if that's something your tax practitioner has discussed with you before, you may want to reach out to them and talk about forgiveness timing for 2021. It may be beneficial to you to try and get your 2021 PPP loan forgiven before the end of the year to prevent some basis issues. And just wanted to touch really quickly on some other grants and whether or not they are taxable. We've had a lot of questions about this. So the EIDL grants and loans. So the EIDL was the program that was done directly through the SBA. You had to apply directly with the SBA. It was one part grant where you received $1,000 per employee up to $10,000. And then you could also receive a loan in addition to that. Initially, your EIDL grant reduced the amount of your PPP forgiveness. They changed that and no longer affects your PPP forgiveness. And EIDL grants are not taxable. Now, state and locality grants, if they are made to individuals, they are not taxable. But if your business received a Rebuild Virginia grant and a locality grant, those are taxable. Federal must be reported on your federal income taxes. Okay. We've got about less than 15 minutes left, which is not a lot of time to cover employee retention credit, but I'm going to try to get through an overview and then some examples of this. But this, again, is a really brief overview. If you are interested in more about this credit, you can go to our website, mwcpa.com. There's a big banner on the front homepage that says COVID relief. And click on that, and that's going to take you to our COVID relief page. You'll find on there a whole section about employee retention credit. And there is at least one webinar, maybe two, that goes in significant detail about these tax credits. And so you'll be able to get a lot more detail about those. And again, we're happy to consult if you have any other detailed questions. So the employee retention credit. So this is a really interesting credit. And I always like to start talking about this one because, where did this credit come from? We didn't hear a lot about it in 2020. So it was actually enacted in the CARES Act in March of 2020. But originally in that legislation, if you received a PPP loan, you were prohibited from claiming the employee retention credit. So the vast majority of our clients received a PPP loan. With the tax exempt status of those loans, they're a little bit more beneficial. You don't have to pay income taxes on those. Employee retention credit does have a tax impact to it. And so, we really didn't pay a lot of attention to the employee retention credit. Fast forward to December of 2020, and the game totally changed. So with the legislation passed in December of 2020, They did a retroactive change to the program and said, oh, never mind. If you received a PPP loan, you can also now apply for the employee retention credit. The only caveat is you cannot use the same funds used for PPP to also apply for the employee retention credit. So as I said earlier, you cannot double dip. So that was a game changer. We were scrambling in early 2021 to see who qualified and how they qualified. And then they extended the program to 2021 with a different set of qualifications. And then originally the 2021 program was set to end June 30th. It was extended again to March 31st, so through the end of 2021. Now, I will caveat that and tell you that many of you may be hearing on the news right now that Congress is negotiating a budget bill and an infrastructure bill. That infrastructure bill, they're looking for pay-fors. How are they going to pay for this? And one of the methods that they are looking at is eliminating the employee retention credit for the fourth quarter of 2021. That is not enacted yet, but there is a possibility that this credit will not be available for the fourth quarter of this year. Again, if you want to stay up to date on all of these changes or know what's going on, please, we're happy to add you to our email blast list. Okay, so I'm going to run through these qualifications really, really quickly. This is a very brief overview. There are more nuances to this. So again, caveat that it's more than just these 4 bullet points on each year. In 2020, if you experienced a drop in revenue or gross receipts of at least 50% compared to 2019 in any quarter, so that's really important. It's not on the slide here, but it's a quarter-to-quarter look back. So what we saw with a lot of clients is that second quarter of 2020 was really where you saw the drop in gross receipts. So looking back from 2020 to 2019, if you were an employer with less than 100 FTEs, full-time equivalent employees, all of the wages paid are eligible for the credit if you meet that test above. And then if you had over 100 FTEs, only the only wages that are eligible are wages paid to employees not working. So if you were paying somebody, but they were doing no work. So that was a little bit difficult to hit. Not many businesses were just paying people to sit at home. I also want to add that there is another way that you can qualify for this beyond the drop in gross receipts. And that is if you were impacted by, and this is not on the screen as well, if you were impacted by a governmental shutdown or partial shutdown. So we've seen a lot of clients be able to qualify with that. I would encourage you to go into to our website and again, watch that recorded webinar on what qualifies as a government shutdown. We were fortunate in Virginia that our governor mandated a lot of things and had some really specific shutdowns. In your industry, construction was considered essential, so you weren't impacted by as many of those shutdowns, but there are some certain situations where you may qualify because of those shutdowns. So for the credit for 2020 is it's maxed out at 50% of an employee's wages up to $10,000. So the maximum credit for 2020 is $5,000 per employee, as long as they were paid $10,000 in wages. The significantly changes in 2020. The credit increases significantly. It gets easier to qualify for this in 2021. So in 2021, your drop in gross receipts only has to be a 20% drop. And this is huge. You're not comparing 2021 to 2020. You get to skip 2020 and look back to 2019. So you're comparing 2019 to 2021. If you dropped 20%, you may qualify for these credits. This is incredibly lucrative credit. We have clients that are receiving hundreds of thousands of dollars from these credits every quarter in 2021. Again, it's getting easier for large employers. They increased the FTEs from 100 to 500. So if you have under 500 FTEs, all of their wages are eligible for the credit. They don't just have to be paid sitting at home. And it's increased to 70% of the employee's wages per quarter. So in 2020, we had a max of 5,000 for the whole year, each employee. 2021, we've got 7,000 per quarter. So extremely lucrative credit. And there are ways that you can coordinate this with PPP forgiveness that can allow you to kind of maximize both. So now I'm going to go through a couple of examples really quickly because we only have a few minutes left to kind of explain how this credit works. So example one, company has less than 100 FTEs. Does anybody have over 100 FTEs? If you could just chat that in real quick, I might skip over these if you don't have, if anybody doesn't have over 100 FTEs. But their operations were partially suspended for 5 weeks due to a government shutdown. So that's how they're going to qualify. The company pays 75% of wages and $200 a week in health insurance. So you can see that for John is not working, Jane is working. Their wages, John only had 4,750 of wages, so his credit is 2,375. Jane had 10,375. Her limit was capped at 10. So for 2020, they received $7,375 just for these two employees. Again, a similar one, they had a 60% decline in gross receipts. Very similar example, just kind of the two qualifications. This one is an example if you have greater than 100 FTEs. I didn't see anybody chat in, so I'm going to skip over that one. And then this is one for 2021, just showing that, again, it's capped at 10,000, but the credit has increased to 7,000. So if they were able to qualify for this for multiple quarters, they would, for quarter one and quarter two, they would receive 27,440 just for these two employees here. So what is interesting about the employee retention credit is this is not a tax credit that you claim on your income tax return. This is a tax credit that is claimed on your quarterly 941 return. So you get the money, hopefully faster. Has been a little delay in the IRS processing these. We're seeing 60 to 90 days processing time. But you can, if you think you qualify for 2020 or even first or second quarter 2021 and you've already filed your 941s, you can file an amended 941 and 941X. A lot of payroll companies are helping with these. And again, this is just a really, really great tax credit available right now. So we've got about 4 minutes left. Oh, Shirley, thank you for sharing that, 2 owners. Now, I do want to say that employee retention credit, currently owners' wages do not count. And the IRS came out with the most insane interpretation of family members of owners. Effectively, if you have no living relatives, if you have no children, you have no parents living, no aunts and uncles, if nobody in your family is still alive, your wages can count for the employee retention credit. But if you have any lineal family members alive at all, your wages don't count. It's just an absolutely insane interpretation. A lot of pushbacks happening on it. But for right now, the way we are applying for this credit is we are we are excluding all owners and any attributed owners, which is lineal family members. So this is overwhelming. Every time I get through one of these presentations, it just reminds me of how much information these programs are, and we completely understand that it's overwhelming. That's why we created a task force within our firm, and we didn't even charge our entire firm of becoming knowledgeable on this. So we are available for consulting services for employee retention credit eligibility and application. We are available for consulting services for PPP 2020 and 2021 forgiveness. And we are also available for tax planning and consulting just for general taxation issues. So that really concludes the information I had today. Does anyone have any questions as we end the presentation here?
Carmen, I just wanted to reiterate or make sure that we were clear. So for the PPP forgiveness portion of it, the major takeaway and alert is to make sure that they start to go through that forgiveness portion of it before the deferral period ends, so that they don't have to start paying back the loan. Is that correct?
Yeah. Yes, that's a big point. But I would add to that, if you think you are eligible for the employee retention credit, wait and make sure, get all of that information together, because you may want to use some different expenses for PPP forgiveness and have as much wages available as possible to qualify for employee retention credit. So what we've been advising clients to do is, get your information together. Let's see if you qualify for employee retention credit as well, and look at how we can maximize these two programs and get you the most forgiveness dollars and also the most employee retention tax credit.
And this is something that they obviously could start now. If they were wanting to look into the employee retention credit, they could contact you guys or their firm to just start working on that process. It doesn't have to be at a certain time.
Right now is the best time. It is a great time to do it. Absolutely, right now. Yeah, it should really be done in conjunction with your PPP forgiveness. If you haven't already applied for forgiveness, if you have a 2021 PPP loan, you should be looking at this in conjunction with your 2021 ERC employee retention credit and 2021 PPP forgiveness. Should be done hand in hand. Yeah. We don't want to leave any dollars on the table. If you're eligible for them, I keep telling people you're going to be paying for them in tax increases in a couple of years, so you might as well get them now while you can. So, unfortunately. Well, thank you so much. Yeah, thank you again for having me today. I really appreciate being able to talk to your group.
Absolutely. Thank you, everyone. And that is all.